Hey there, and welcome. Today, we're going to dive into two words you've probably heard, but maybe aren't totally sure about: amortization and depreciation. Now, I know they sound a little intimidating, but trust me, they're actually incredibly powerful tools for understanding how businesses, and yep, even your own personal finances, really tick. So, let's get into it. So let's kick things off with a scenario. Picture this. You've finally done it. You've opened your own small bakery. And you just made your first huge purchase, a beautiful, shiny $10,000 oven. It's the heart of your business. But now, what do you do with that giant receipt? And right there, that's the big puzzle, isn't it? I mean, if you just write down that entire $10,000 as an expense for your first year, your books are going to make it look like you lost a ton of money, even if you were selling cupcakes like crazy. So how do you handle a massive cost like that without making your business look like a failure on paper? Well, the answer lies in the two concepts we're talking about today. The solution to our bakery problem comes from these two key accounting ideas: depreciation and amortization. At their core, they're both just clever ways of spreading out a big one-time cost over a longer period. But, and this is the important part, they each deal with a totally different kind of asset. So what's the real difference here? Honestly, it's super simple when you break it down. Depreciation is for tangible assets. Think physical stuff. Things you can actually reach out and touch, like a machine, a building, a truck. Amortization, on the other hand, is for intangible assets, all the valuable stuff you can't touch, like patents, brand names, or copyrights. Oh, and it's also used for loans. So just think, physical versus non-physical. That's the main idea. Okay, let's zoom in on depreciation first. This is exactly what our bakery would use for that $10,000 oven. I mean, that oven isn't going to last forever, right? Every year, it gets a little older, a little more worn out. Depreciation is simply the official way of recognizing that loss in value over the oven's useful life. It lets the bakery spread that cost out year after year.
And then you've got amortization. Let's imagine our bakery invents a one-of-a-kind cupcake recipe and gets a patent for it. That patent is super valuable, but you can't touch it. It's an intangible asset. Amortization lets the business spread the cost of getting that patent over its legal lifespan. And, like we said, it's also the word for how you structure loan payments over time, like for a startup loan.
All right, enough with the textbook definitions, right? Let's see how this stuff actually plays out in the real world. To do that, we're going to follow two totally different entrepreneurs, Sarah and Mark, and see how these concepts are absolutely crucial to their businesses.
First up, meet Sarah. She runs a construction company. Her business is all about big, heavy, physical machinery. We're talking excavators, dump trucks, you name it. These are the definition of tangible assets, which makes Sarah's company the perfect place to see depreciation in action. Okay, so Sarah buys a new excavator for $100,000. Ouch. She figures it'll probably last her about 10 years before it needs to be replaced. So, using a simple method, she just divides the cost by its useful life. That gives her a $10,000 depreciation expense every year. Now here's the crucial thing to get. This isn't $10,000 in cash leaving her bank account each year. No way. It's just an entry on the books that lowers her company's taxable income. It's a paper expense.
Now, on the flip side, let's meet Mark. He's the founder of a tech startup. Unlike Sarah's business, which is full of physical stuff, Mark's most valuable assets are things you can't see or touch. We're talking about software patents, trademarks, intellectual property, all classic intangible assets.
So Mark gets a patent for his new software that cost him $20,000, and it's good for 10 years. Now look at the math here. He divides the cost by its useful life, and he gets a $2,000 annual amortization expense. See that? It's basically the same logic as Sarah's excavator, just for a non-physical asset.
But wait, amortization has that second job, remember? Loans. So Mark also took out a $100,000 loan to get a startup off the ground. The way he pays that back is also through amortization. What that means is, for the first few years, his monthly payments are mostly just paying off the interest. But as he gets further into the loan term, more and more of his payment starts to attack the principal, the actual $100,000 he growed in the first place.
Okay, so we've got the what and how down. But the big question is, why does any of this actually matter to you? Well, because these ideas aren't just for accountants. They have a massive real-world impact on businesses, investors, and, yep, your own wallet.
First off, if you own a business, or are even just dreaming of starting one someday, you absolutely have to understand this stuff.
For an entrepreneur like Sarah, depreciation is a game changer. It lowers her taxable income, which saves her real money. It also gives a much more accurate picture of how profitable her business really is. And maybe most importantly, it helps her budget and plan for the future so she's not caught by surprise when that huge excavator finally gives out.
Now, what if you're an investor? Well, if you are, these numbers on a company's financial reports, they're like a secret code that tells you what's really going on.
If you see a company with really high depreciation, what does that tell you? It might signal that their equipment is getting pretty old, and they're going to need to spend a ton of cash soon to upgrade. If you see high amortization, it could mean they're all in on innovation, like Mark's company, or it could be a red flag that they're carrying a huge amount of debt. It helps you see beyond the marketing and understand the real health of the business.
But, this isn't just for Wall Street gurus or business owners. This stuff shows up in your personal financial life all the time, probably more than you even realize.
Seriously, if you have a mortgage on your home or a loan on your car, congratulations! You are already dealing with an amortization schedule. And understanding how that works, how much of your payment every single month is just going to interest versus how much is actually paying down what you owe, it's absolutely key to making smart money moves. Okay, before we wrap this up, I need to make one thing crystal clear because it's the biggest point of confusion. Let's say it together. Depreciation is a non-cash expense. The money was already spent, gone, the day the asset was bought. Depreciation is just the accounting trick to spread out that expense on paper over time. It is a number in a spreadsheet, not a check you write.
All right, we've covered the definitions, we've walked through the examples, and we've talked about why it all matters. Now it's time to take this knowledge and apply it to your world.
So I'll leave you with this question to think about. Look at a big asset you own, like your car. It is depreciating every single day. Or look at a big loan you have, like a mortgage or a student loan. That's amortizing with every payment you make. How do these powerful forces affect your own financial picture? Because understanding this isn't just nerdy accounting, it's the bedrock of being financially savvy. Thanks for tuning in.